Welcome to this week's edition, October 13th, 2023, closing bell. We got Salt and Pepper here, and we're in effect. We're ready to roll. Mark,
Yeah,
how you doing?
I'm doing fine. Just a lot of things going on here we need to talk about in our world. It's been kind of crazy, right? So let's talk about some of the key topics for this week for sure.
Absolutely. But to echo your statement, it's great doing these with you. I think this hits home a little bit more, just what's going on in Israel, which is kind of our first topic we'll get into. But yeah, as fathers, as human beings, as Christians, I think just the week's events have just been absolutely horrifying. And I know you have been praying. You and Mom have been praying,
Oh
and
man,
Melissa and I
yeah.
have as well. It's been horrific. I really don't have any words right now. Honestly, it makes me choke up when I think about it, and the women and children, and even men. It's death is never good. So.
It's shocking what's in the human heart to be able to be as evil as we've seen this week. And it's not surprising because I think the Bible talks about that sin in our lives. I mean, we can go to deep, dark
Yeah.
places,
Yep.
and so our hearts and our prayers are with all the people involved is for Israel, for peace in Israel,
Yep.
and for wisdom and how they respond, how we respond as a country in backing them. I take great comfort in the fact that and so interesting that from biblical prophecy and things that have been written about thousands of years ago, it's crazy to see the way things are aligning. So I don't know. I'm not saying that this is the end, but it's just really there's a lot
Feels
of
like it during it, doesn't it?
really incredible things happening prophetically from Scripture, and as Israel is surrounded by enemies. But anyway, very we're very thankful God's in control, and that we're praying the Lord for their wisdom and for all the people that comfort those who've been severely impacted in this situation.
Mm-hmm.
Our hearts and our prayers are with everyone involved.
Absolutely. Couldn't have said it
Yeah.
better myself. So, but the reason why we want to talk about this, we're in the business of finance and world events, geopolitical events. They do impact markets and all of our lives in different ways. So, while we want to be sensitive to the fact, we do want to, kind of get into the numbers a little bit and see. We'll talk about interest rates. We'll talk about oil. We'll talk about, and the implications for the equity markets as well, and get your thoughts on each here. But let's talk about, geopolitical events. Stocks usually take them in stride, right? I mean, it's pretty interesting. If you look at this chart here, and we'll kind of get into what this conflict, what we think might go on, but uh, dating back to Pearl Harbor, right? December 7th, 1941. That 1 day section there is a single day drop after the event took place, almost 4%. And the total drawdown would be, the total kind of support level, I guess you could say, it went down to about almost 20% of a drawdown from the prior day's market price, right? I guess you could say, um, from when those events happen. So
Yeah.
the bottom obviously is how many days it took to bottom to equal the max drawdown, and then the recovery to get back to pre-event levels. So any thoughts? I mean, obviously you've seen quite a few of these on this list. Not that many. I'm not saying you're old, but
Easy,
I mean,
easy.
but I mean,
Right.
if you look back, what let's see here.
Cuban Missile Crisis was about when I was born,
There you
62. Yeah.
go.
So I heard stories about that. That was pretty. We were really close to nuclear war right then. Wow. Might
Hmm.
have been. I was just actually. I was a month old at that point. Wow, that's crazy. 10, 16. But yeah. So I think the point here is that markets react to unforeseen things that happen. Obviously, I mean, I think the first inclination in any situation like this, where there's a surprise attack or some type of event that's happening that the market hasn't expected, that there's an initial reaction, and some of it, some of those reactions are really short lived, and other ones can go on for a while. I mean, Pearl Harbor already, so like World War II, right? So that as you see there, it took 143 days from the event actually that the market actually bottomed. So that's a long, that's a long, so it's a period of time that's sort of like painful to watch that
Yeah.
go down. But at the same time, my parents, my dad was in Pearl Harbor. They were focused on, winning that war and fighting and keeping America free. And so, probably, stock markets took a little bit of backseat for the normal person who was having to go to fight for their country at the time. But bottom line is, a year later or so, the market had recovered, and you know, uh, and it will do so. So we don't know what this situation in Israel with the Gaza Strip and what's going on there, how long this will last. We'll talk about oil. That'll be kind of the main thing to watch, and how this
Yeah.
escalates if more people, especially Iran, get involved. Um, and or Russia, or some of the different countries that are aligned around Iran. So that's going to be the interesting thing to see. Hopefully this can stay contained. It's a terrorist attack, and they need to go do business. Israel does, and so it's it might be maybe short lived, but maybe longer. So we don't know. So the point is that I think this graph just shows you that the markets do recover, and some have more or less different types of effects, when it happens. You can always see, I mean, this doesn't show it here, but if you go out 5-10 years from these specific events, you usually have significant upside growth in markets over that period of time. So, but it can affect you in the short term for sure.
Mm-hmm. And just for the listeners who can't see the current slide that we're talking about, the Israel-Hamas war, which started on October 9th of this year, a day after, it was actually up 0.3%, the S&P 500. Again, as Mark said, to be seen how long this lasts, the containment of it, is it localized, does it expand to Iran and China, Russia, whoever else may join the theater. But overall, if you average out all of these events, these geopolitical events that have happened, we'll have a 1-day drawdown of about 1.1%, total drawdown of about 4.7%, averaging about 19.4 days to the bottom, and recovery on average of 42.3 days. So to pre-event levels. So not very long, like you said. So that should give us a pause for optimism. Again, want to be sensitive to what's going on, but just in terms of markets here, if it recovers pretty quick, even after some pretty big events that have happened. So, but let's dive in again, kind of to the war in Israel topics here: interest rates, oil prices, equity market implications. So, interest rates, everything that's been going on could impact the trajectory of interest rates, again, depending on how much is contained here. Currently, the probability of Fed increasing the target rate has dropped below 20%, which before last time we talked, I believe we said it was about 30. It's dropped below 20 now. So this, investors are kind of pricing in the fact that maybe this will kind of put a brake on the global economy as we kind of feel and wade through this horrible situation. And also, even though there was a robust job report last week, again, we're sitting at about 200,000 initial claims. Continuing claims just got to 1.7 million this past week here for continuing jobless claims, which again is that psychological number, 1.7 million. Still super healthy labor market, which is again surprising even to us as we see the economy is trying to slow down a little bit with these higher rates. So
Yeah,
we'll
yeah,
see, but right next month or November, probably no rate hike.
yeah, probably not. And again, those numbers, I was going to say is those numbers, they were high last week, but a lot of them were part-time, seasonal. That's kind of the numbers that jumped out there. That's it's going to be interesting to see how that plays out. Might have been sort of a false high, but again, the point is the job market is still strong and pretty healthy, albeit maybe part-time versus full time is a different type of number and not reflected necessarily in those numbers that came out. So yeah, I
Hmm.
mean, a
Yeah.
point, and I think that a lot of things going on here, a lot of different things coming at us, and so what's all to say is that it looks like we're getting to that place, like you talked about, interest rates is sort of leveling out in here, and that's the market thinks that they're going to probably hold steady in this next meeting, which is really positive, right? That's something that we've been waiting for. We think that that's probably going to be in fact what happens is that they'll pause and hold for a while here and see what happens.
Now you touch on oil prices, to me, and I think a lot of people think about, oh man, like Middle East oil automatically. Well, luckily, again, I hate saying luckily, but I mean, that region of the world doesn't have many, oil refineries in that specific region of Israel, Gaza, that geopolitical area. But what's interesting is, again, what you talked about, the more global ramifications of, okay, well, how does Iran play into this? There's reports that they backed, Hamas, using cryptocurrency and provided weapons and all this kind of stuff, right? And so what does this mean? Like, how are they going to get involved even more? What does that mean for OPEC and Russia in terms of how we react to this situation, and how are they going to react to us reacting to what's going on in Israel, right? So are they going to decrease supply to try to freeze us out a little bit more and get us to use our strategic oil reserves, which are down 43%, right,
Yeah.
from the start of Russia-Ukraine war? So talk to us a little bit about that.
Yeah, it's concerning. I mean, I heard this week that we're down to 17 days in our reserves. Um, wow. I mean, and then they want to tap into it more for this situation. So it's that part's concerning to me. I mean, because we're vulnerable there, and looking back at our administration, that one of the first things that happened when the Biden administration came into power is they stopped drilling here locally. And we've talked about this over, and my
Mm-hmm.
opinion on that is like, I can't, I think it's been the significant reason why, uh, again, totally my opinion, but I think it's a significant reason that, we've been fighting inflation this whole time. The price of crude oil is in everything.
Mm-hmm.
I mean, it's in shipping, it's in trucking, it's in anything to get products to consumers. If the
Yep.
price at like the PPI, which we talked about, PPI, CPI, the two, if producers have to pay more money to get something to a consumer,
Yep.
then that's embedded in prices that they're not going to pay more. They're paying more money, but what are they going to do? They're going to give that's
Pass
going
it
to all
along.
go to the consumer. So
Yeah.
that's why inflation pops up. So there's been this war on crude oil for whatever reason, and it's put us in a vulnerable position, and that's why I think we hope that it stays contained here in this war. I don't know. I don't. It's hard to figure how Iran's not been involved and how they won't get deeper involved. Especially as Israel talks, and that's where the price of crude,
Right.
we could see a pop there.
Absolutely.
We recommend slightly overweight, in oil, companies, things, and anything with energy, I think is
Right.
looking more solid.
Mhm.
And that would be a reason, in our portfolios, we've been, with our managers and so forth, taking higher. We have most people in those areas, and so I think that'll be an area that is positive going forward if that in fact happens with oil prices. But
Right. Yep.
yeah,
Higher prices, higher earnings for those companies
yeah,
potentially, and
and
therefore,
drillers, anybody really involved there, yeah,
absolutely. All right. So before we close up this topic here, equity market implications, we briefly talked about how markets react to geopolitical events. And again, the increased risk premium obviously embedded in oil prices right now. We talked about volatility index, which is actually down recently. Um, and prices have kind of decreased a little bit. We talked about a bad third quarter that we just had in last week's video and podcast. But any closing remarks? Get it, Mark? remarks.
Oh, there you go.
On the equity market implications, anything more? I know again you just talked about energy, but anything else that kind of stands out for you
Yeah.
with the topic?
Well, just, the markets actually last Friday, started kind of a new attempted rally and got a follow through day and, looked pretty solid. But then this war in Israel happened. So, we're getting a little bit of pullback. That's probably why the VIX is coming back up, because it had dropped now that,
Mm-hmm.
looked like we were holding some key support lines in the S&P, and
Yep.
NASDAQ has been strong. And we got some, earlier this week, it got some, some good moves. We're giving some of that back here at the end of the week. So we'll see where that plays out. But again, all eyes are kind of on this world, uh, what's happening in the world right now, and the markets will respond to things that, are surprises. That's how where you get the
Yeah.
sharp increases or decreases in the market is basically on surprises. But bottom line, it's going to be, we're entering earnings season. Some of the banks just came out, the large banks had blowout earnings, which is not surprising after all the bank issues we had earlier in the year, that the big banks are
Mm-hmm.
doing well. It's going to the big question is, they're going to see how's the regional banks doing and the smaller banks, because that's where
Yeah.
the real strength is in our economy. So that's going to be important. But we have earnings coming out here soon, and the next few weeks is going to be, we'll see how their company's doing. Could be the first time in a couple quarters that we actually in the earnings recession, and maybe, the projections, our earnings are going to be stronger,
Yeah.
going for higher this quarter. So we'll see how that plays out.
And just for our audience, just so they know, like at time of recording here, Dow's up about 0.73%, S&P 500 up about 0.38, NASDAQ up, down, excuse me, about 0.26% for the week, having a bit more of a down day, about 1.5% down today. And then the Russell 2000, which are your small cap companies, down about 1.6% for the week. So
Yeah.
kind of flattish. Again, people are wading through all the news, but this kind of leads into the next topic, because it's exciting in terms of like, this is uncharted territory for a lot of people, because yields have historically been low for the past decade or so, right? I mean, interest rates have been alarmingly low as free money being passed around, and obviously it's good for some areas, not so good for others. But obviously, as you said, big banks increase earning potential because they're getting more interest on their money. So and charging on their loans that they're loaning out. So surging yields, that's kind of a big thing we'll talk about today. It's kind of bringing the stock market into a little bit murky waters here lately. It's actually, so recent bond sell-off, we've been talking a lot about bonds been selling off lately. 10-year treasury note has increased above 4.8% since first time since 2007,
Mm.
and has potential to have long-lasting effects on the stock market, because obviously it influences, which stocks lead the market and when major indexes begin their ascent again. So let's talk a little bit about this, and then we can kind of talk about big tech and
Yeah.
who may be leading the market coming up here.
Well, I mean, from this chart, right? So looking at that chart, the green line, if you can see this, you're watching this and you can see the chart. The green line on the U.S., the rise in yield has been incredible this year.
Yep.
And that's been a headwind to bonds, to the price of bonds, because again, we've talked about this before, the inverse relationship between bonds and interest rates. As interest rates go up, the value of bonds goes down, the principal value. You're still locked into your, if you hold a bond to maturity, you still get your interest rate and your par value at maturity. But in the meantime, in the secondary market, the principal value of that bond may go down, or will go down as interest rates go up. And it depends
Yep.
on the duration. Shorter term bonds react less, less,
Great.
they're less affected by higher rates. Obviously, at 10 year, and as this shows, when you're going out 10 years, it impacts the market value more significantly. So that's been a negative. And this is just showing like the S&P 500 earnings versus the yield. And we have, like, when you see those come together, it can make stocks less attractive, because why do I buy stocks because of earnings or the potential of increasing earnings of what
Yep.
a company does. But in this case, if I can get a same or similar return off of a safe U.S. 10-year Treasury mark, then I'll probably just stick with the bond. So that's going to be interesting to see. It affects the growth stocks, higher rates because of the way future earnings are discounted, and it just hey, I can get a safer return in something that's what we thought was again before this year. Bonds have always been that safe haven, but we've seen here
Mm-hmm.
recently that they've kind of gotten hit a lot. But now, again, still going forward, if we get a pause in rates, if we get even a decrease in rates going forward sometime in 2024, you'll actually, bonds will be the place to actually, really have, part of your asset allocation
Get
there,
capital
because
appreciation.
yeah,
Yeah.
you'll get not only that higher yield, which is beauty of bonds right now, but also you'll get the capital appreciation as if and when rates start coming down again. So yeah, so that's I think it makes it, again, I think it brings back at this point the 60-40 idea, or the 70-30 kind of portfolio, where you have a good amount of your money in bonds. Makes a lot of sense right now, and could be a time where it's really positive, and doing bonds, doing what they should be doing, is being a ballast to offset the volatility of stocks, but also throw you off some really nice income as you go forward. So yeah, it's interesting. We haven't seen this in quite a while, and I think again it gives out validation probably to a 60-40 kind of idea on a lot of portfolios.
Equity risk premium is the lowest point, which you just talked about right there. That's the official word, equity risk premium, lowest point in over 2 decades. So those two graphs there, if you can see it, if not, the closer that the S&P earnings yield and the yield on the 10-year Treasury note come together, closer together they are, the less equity risk premium that there is to owning the S&P 500 or stocks. So good knowledge there, and it's been kind of interesting, right? Because Nasdaq obviously had a killer year so far, right? I mean, it's pulled back quite a bit here, but there's 7 names, so we'll talk about that, which is the second chart here. There's been a few pretty big winners this year still. You got Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. They collectively constitute 30.5% of the total S&P 500, because that's all market cap weighted, right? So as market capitalization goes up, they hold a bigger share. They used to hold 21.5% at the end of last year. So it's already increased 8.5% of the total weighting of the S&P 500 in 10 months now, which is pretty wild. So that's the second chart you see there. And if you can't see it, again, it's just a chart showing that these 7 names I had just mentioned are accounting for over 30% of the total weighting of the S&P 500. 7 of the 500. That's pretty remarkable.
Yeah.
But going back to this real quick, Mark, you and I have talked and kind of sung the praises of value stocks, and how instead of betting on, again, the growth rate of a company, more looking at their value, the price to earnings, price to book, again, how relatively cash solvent they are, free cash flows, earnings potential, earnings growth potential and estimates, and growing that over the long term. We've seen those really underperform this year, right? The Dow touched actually negative territory last week. We're hovering around, even at this point. Talk about the value of value stocks, especially in times like this, when times are uncertain.
Yeah, and it's interesting. I saw a chart this week, and we don't have it here, but it was showing that there's been a few other times in the last 30 years or so that that these high flyers, that there's been a select few stocks that have really risen and become a higher proportion of like an S&P 500. For one, I always remember 1999, early 2000s, when in the .com era, where anything with a .com associated with it was just flying up. and there were
Yep.
some significant stocks at that time that had a higher percentage of the portfolio. They were just growing. That was where all the growth was coming from, was the tech stocks. And then everybody wants to be in them. They're going to keep going up. They're going to keep going up. Everybody gets there's that frenzy. And I'm not saying we're at a bubble right now on these stocks. I think some of them still they have really great earnings. The beauty of this time is that these stocks all have good earnings. It's just that their PE ratios are
Yep.
getting really high. It's not that they're not great companies. It's just that they're getting more and more expensive. And so when that happens, typically, and it takes time, but usually, at some point they don't necessarily drop a ton, but they might go sideways for a while, and they to catch up, and because people, investors start finding opportunities in value stocks, and that's what your question was, and that's where we feel like there's a
Yep.
lot of opportunity in those places. They've been underperforming, they've been out of favor for quite a while, and they might be for a little longer in here, but at some point that's going to change. It's kind of like that international investing.
Yep.
The same thing is you gotta realize that everything kind of goes back to the mean, and it reverts back to the mean, and there's going to be a time here where those are going to outperform these other areas. So we don't know when that is, but I think that value dividend paying stocks have historically long term been incredible, because dividends have been a significant part of total return over the years in the S&P
True.
and the Dow, and they're less
Yep.
exciting now in this current market, but doesn't mean they won't be. If things go sideways for a little while in the economy, or even down, you're gonna want to have money in good solid dividend paying stocks. So so all this say is this diversification is really important, and don't chase returns in here with too much money in the high growth stocks, because they may not continue to go and increase at that same level. We don't know for sure, but that's the point is just make sure you're diversified.
Good points. And just to bring up a name we talked about oil, energy, a lot of those names, Exxon, Chevron, who have benefited the last few years from higher, oil pricing per barrel. Those would be some, again, not all of the names, but some of the names that we talk about in terms of valuations, got steady profits, free cash flows, low debt, things of that nature that we look at. But again, that would just be an example that we talked about before. But great insight and great points. One last topic we want to touch on here for this week's episode of The Closing Bell is CPI and PPI, consumer prices and producer prices. You briefly mentioned producer prices and passing it along to the consumer, which obviously they tend to do. Some don't, but most do. And just talking about the numbers that came in this month. So if we're looking at PPI, let's start with the producing side of things, the producer side here. Results came in slightly higher than what economists had anticipated. Year over year figure came in at 2.2%. And then obviously that's revised upward from 2.0 in August. Now the core, which strips out volatile food and energy, came in at 2.7%, again below the 3% threshold, which was observed in 2021. So again, 20 basis points higher than what we expected, what was higher than last month, excuse me. But again, way down from the 9.6% that we saw in April of 2022. So anything to talk about producers before we get into the consumer side? I know you kind of already drove that point home when we talked about the economy earlier on.
I mean, significantly lower than we were a year or so ago. So that's good news. But again, the producer price index is really important to keep an eye on, because that, is again what the producers are having to pay up
Yep.
in regards to producing some type of product. So those get passed on eventually, and the good news is it's going in the right direction. But again, the thing to keep an eye on is simply these oil prices and how that's going to affect the producers, and what they have to pass through, and then also, that we talk about it, but the labor costs as well. So those are key numbers and key places to keep an eye on. But they're going in the
Good
right
point.
direction right now.
Absolutely. Now, going on, passing it along to the consumer, year over year is the metric the Fed looks at. Obviously, when it looks at whether or not it's going to raise rates, uh, currently stands at 3.7% overall headline inflation rate. Core came in at 4.1%. So again, trending in the right direction overall. The headline inflation kind of reared its head a little bit higher than the past 2 months here, but again, 3.7's kind of on that target path to 2%, even though you and I both believe if we're settling somewhere in the threes, that's the historical average around the last 90 years or so. So I think higher for longer rates. I think higher for longer bottom line rate as well.
Yeah.
And then the economy should be able to function just fine on that, especially if we increase the supply side. Again, have a booming economy, allow us to cut some red tape and really let the U.S. Innovation and ingenuity really take hold. So that's my opinion.
Yeah, I mean, if you're looking at that graph, I would venture to say, and I would predict that those numbers are going to stay right there around that 3 to 4% will be what quote higher for longer. I think that's where we're going to end up. Again, you just mentioned it's last 90, 100 years that's been the average. I think we're headed and going to stay in that average area for a little while. So, but the good news in that, once companies back to the companies and how they are impacted by that, and the consumers, everybody reacts and responds or gets used to that kind of scenario again, then the
Mhm.
economy can just move along, just fine. You can't just at higher rates, where it's just the reality of how life is going to be here in the future is higher rates. We had because of the situation in '08, the financial
Mhm.
crisis and all that. We just had a period of time where low interest rates they were just a part of what we are. We got used to them, but it's never been something that's been the overall long term average. So that's where we're going to be, and that's so get used to it. I think that's what I would say. Get ready, get used to that. We think it's going to stick around that way for a while.
Great insight there. Well, I think that's all for us in this week's episode of The Closing Bell. Mark, thanks so much for your brilliant insight. It's always a pleasure doing this with you. Any closing
Likewise.
remarks before we let the audience go?
Yeah, I mean, just keep praying for peace in Israel. That's I think prayers are powerful, and let's continue to keep our people in prayer, women and children, in those
Yeah.
areas, and that hostages and even people in Gaza Strip that are kind of stuck in there, the families,
Yeah. Yep.
that they can get out safe and
Yeah.
sound. But like to those though who are um, guilty of this atrocities, will be brought to justice. I mean, we can't
Absolutely.
have we can't
Amen.
this can't happen
Nope.
any going
Nope.
forward. So
Nope.
yeah, so that's my prayer, and get us call us if there's anything you need on your portfolio. We're here to help, and but we'll be fine. Let's just stay diversified and yeah, positive. It's gonna be okay. We're gonna get through this.
And keep listening to The Closing Bell and our other Move the Chains podcast, which will be monthly, highlighting some more awesome financial planning topics, such as, charitable giving. And that's a big part of what we believe, obviously giving to those in need, and giving to organizations that need our help as well. So I think that'll probably be one of the big ones in the works here, but also talking to some exciting guests from different spectrums of the economy, investments to sports. We had Misty May on, that was great, and um, Carrie Wall, or sorry, not Misty May, Carrie Walsh, her partner,
We talked
Carrie
about Missy
Walsh.
May. Yeah,
We
Carrie
talked
Walsh.
about Misty May. That was really fun. She's
Yeah,
great.
that was great.
Um, but yeah, we've had some great speakers so far, and we'll continue doing that. But we'll see you guys next week again. If you need anything, let us know. It's an honor to do this and to serve you. So we'll see you next time.
God bless.